It is Thursday, July the 21st. And my question to you is, are we or aren't we in a recession?
Well, that's a trick question. The answer is we don't know because we haven't gotten the data for the second quarter GDP. Things feel like we're in a recession. Pain of inflation, both at the pump and at food, buying groceries,
Unemployment rates are
unemployment
at
rates.
8-month highs.
On new this morning, a slight uptick in unemployment claims would indicate that. Major companies laying off or slowing down workers would indicate that. And the Federal Reserve is kind of backroom smiling because that's what they need and they want a slowdown. So for all practical purposes, we certainly, if we aren't in a recession, we're heading towards a recession. But in the purest technical sense, we don't know because we haven't had the second quarter GDP numbers. Now, next week, we'll know that.
We'll know that next week. And one other thing is that mortgage applications are at 20-year lows.
Right.
And we put a lot of emphasis on what happens in the real estate market with where we are from an economic standpoint. And so we're really seeing the door slam on new mortgages because rates have gotten so much higher.
But the reality of it is that the Federal Reserve, they would never admit we want a recession. But they would admit we need the economy to slow down, we need to get inflation down, and we need to get back to a more parity of a normal interest rate and then normal hiring numbers, normal employment numbers, all the stuff that they say would be the place that they want to be in terms of a growth market. So they want a slowdown. They want they would not be upset about a recession as long as it wouldn't be deep and long, and they're thinking they can orchestrate a short, soft landing in terms of the economy. And therein lies the big question.
Yeah, and I don't think it can be a soft landing. I think putting foam on the runway for the plane to land it may break some of the fall, but not all of it. So I think we'll have a somewhat of a painful next 6 to 12 months.
But I'm encouraged by where we are and what we're seeing on an average basis. Now I know we have within our client base the both the extremes, both to right, having more in stock than our average does, and to the left doesn't have as much in stocks as our average does. But for those that are in the middle, the loss that we know we are year to date is nowhere near the loss in which is being showed for the S&P 500, which is in a very high double digit in the 20% range.
It's a bit like putting lipstick on a pig when you're talking about, hey, we're not down as much as the S&P 500. In fact, we're not even close. However, that's what part of the reason that you pay us for is to mitigate losses. And I think we've done a successful job of that, at least so far.
And what it does for us, it gives us the ability to recoup those losses on a quicker basis when the market begins to turn. We still are in a good cash flush position. We saw for the first time this morning, prior to the Fed funds rate increase next week, a first high-quality corporate investment grade bond that is giving for a one-year return a 4% rate of return. We believe next week we'll see more of that, and part of that cash we're going to allocate to that. And then we've done collectively here, we've created the shopping list of what we want to buy, both in the dividend and growth areas, and selectively and over time, we're going to take advantage of that. So we're going to navigate our way out for that.
Yep, we don't think the time is here yet for purchasing stocks. I think we could still see some more downward pressure, but we've got plenty of dry powder and we'll react accordingly.
Hey, before we go, let's take this quick moment. Jess came in and said she had a phone call from a client, and rightfully so, who's seeing the individual bonds that we bought. And when they look at them, they're showing a negative or you've lost a little money on that. Let's talk about that real quick and clear that up.
So yeah, anytime you buy bonds, whether in a mutual fund or individual, they're going to reprice as interest rates go up
Daily.
daily. And so if you were taking those bonds to market to sell today, most likely you're going to get less than what you paid for them when we bought those bonds a month ago, 6 weeks ago, whatever that may be. But remember, the difference between a mutual fund full of bonds and individual bonds is when the bonds mature, you get back $100 a unit that you purchase. So if we bought it at 98 or 99 or even 100, you're going to get back 100 just internally versus going to market and sell, because the bond effectively will end when the maturity date ensues.
So what you're seeing when you look at your screen is the assumption of if you were to sell today. And again, we aren't going to sell today. We're going to get to the maturity date, get a whole reckoning of the value, and then make a decision on what we're going to do. So don't worry. Don't panic. We haven't put you in something that is losing money. It's just how it's being accounted for on a daily basis as you look at
Because the bonds that are going to
individual
be issued at the end of this month are going to have a higher yield than the bonds that are currently out there.
Right.
So when you have that, it moves the price downward on those bonds that have a lesser yield than the new issues. So that's what you're seeing. Hold to maturity and you'll get the entirety back.
All right, we're looking where inflation's going to go. Are we getting to the top, or do we have a little more to go? We're looking when it does roll over, where's the bottom to begin to buy in? But we're doing it here because we know it is your money.
And your money matters.
Call us if you have questions or concerns, but thanks always. See you next week.